We will now look at the typical structure for a real estate joint venture. With regards to capital provision, you will typically have an investor that may invest 95% or 98% of the equity capital. That investor is often a series of limited partners managed by a general partner, and those limited partnership relationships or limited partner relationships will be governed by the terms of a limited partnership agreement. The investment doesn't have to come from a fund structure. It could be a corporate structure, but fund structures are common. So that the limited partners do not themselves have to invest in the JV entity, the limited partners will often hold an Investco LP, which is a special purpose vehicle, which will then itself contract with the operator investment vehicle, also known as the asset manager or a fund manager, to form the JV entity. This will be done pursuant to a shareholders agreement, often called a joint venture agreement or a partnership agreement. And the operator investment vehicle will invest 2% or perhaps 5% of the equity, with the investors investing as much as 95% or 98% of the equity. This then forms the joint venture entity. Depending on what's most efficient from a tax perspective, the fund manager may contract directly at the limited partners level, or alternatively, the asset manager will contract at the JV vehicle level. Let's assume for the purposes of this example that the asset manager is contracting at the JV vehicle level. The asset manager, which is then 100% owned by the operator investment vehicle, will enter into an asset management agreement with the JV entity. The PropCo, which is the owner of the property, will be a party to that asset management agreement in order to take the benefit of the asset management services that the asset management company is providing. Likewise, the joint venture entity will enter into a property management agreement, typically with a third-party property manager rather than a connected entity to the operator investment vehicle. Again, the PropCo will be a party to that property management agreement in order to take the benefit of the property management services. The joint venture entity will then own one or a series of SPV vehicles which will sit directly below the JV entity within the capital structure. The seller of the property or the shares in the PropCo will then contract with one of those vehicles, or indeed with the PropCo itself, in order to transfer the interest of, in this example, the single asset to the PropCo vehicle. This will be pursuant to a sale and purchase agreement. It is typical in real estate joint ventures of this type for the investment to be leveraged with bank debt or alternative capital provider debt. That third-party debt is typically invested either at the PropCo level or at the level of the corporate vehicle that sits directly above the PropCo. The bank debt provider will wish to enter into a duty of care agreement in order to take the benefit of the services provided by both the asset manager and the property manager.